So today marks the last day on this massive earnings week, guys. And what a week it was. It was a week of highs. It was a week of lows. It was a week of a lot of tears and a week of a lot of laughters. But right now we're at the end, and it's Friday. So we only had pre-market open, the one that had earnings this Friday. And guys, the only two companies that we really want to take a look at right now is the companies ExxonMobil and Chevron. So those are the main two that we are going to take a look at in regards to their earnings. You know, oil companies. For all of those of you who don't know, I love my oil companies because, Chevron is I'm gonna say right now, I have a massive bias towards Chevron, like massive bias towards Chevron, because not only is it my biggest company that I hold, but it's also my biggest dividend payer overall. And luckily for me, I actually managed to buy this company at very good valuation. So I'm gonna go over that when we get to that. And at the same time, guys, we're also gonna cover Chevron as well. But before we get to all of the companies that we want to do, I would like to actually go over, or we would actually like to go over, the comment by Anthony Brown. He left this comment on, I believe, the Jackson video. And if you're watching right now, then welcome. If not, you could just watch the VOD. We're pretty much just, it's the beginning of the stream. So, but Mike, do you want to address the first part of it? Because that mainly has to do with you. So if you don't mind, just read it and then address it. Thank you.
All right, so let's see. We got he's asking about still new is JXN currently in a head and shoulders pattern, and I'm assuming you're referring to the daily. If not, I'm going to clarify if I see, but kind of it may be and maybe not. I'm going to share my screen just so we can have the same context.
Yeah, let me bring that up then. Let me bring up your screen then. Okay, and your screen is up.
So if you see here, yes and no. Why I say no, because you've established the neckline and you are basically bouncing off of this region here that is your neckline. You shouldn't theoretically be bouncing there. You should form the right shoulder, the head, left shoulder, head, right shoulder, and this is your neckline here. The second you came down to it, you should basically flush the lows and headed lower. If I look at the weekly, just because it hasn't traded for so long, almost anything can appear like head and shoulders because you're going to have a push up, push down, push up, push down. The weekly is showing still separation on the MACD, and the RSI is actually showing progression to the upside. I do think this could curl to the upside, get above that 50 line. You could start really pushing up higher. I don't like the sell-off, forming possible bear flag. But the thing is, you're sideways consolidating and you haven't really broken the consolidation down. So until that pattern basically gets broken, essentially you can draw the chart out like this to form your flag or your pennant, however you want to describe it. If I look at this, you made a weekly lower low, but failed to hold the further part of the wick. So there's a lot of bullishness there. So you're in consolidation. That's basically what I can sum up is this is consolidation. Now, is it consolidation to go down? I think you're basically going to find out on this next push up. You have a MACD starting to curl up. So basically, if you get above this line, essentially $38.57 is where $37.87. That's roughly where I'd be looking to see this break out. If it gets rejected there and you start coming back down, I'd be looking more bearish because this is going to kind of more confirm that bear flag pattern, which would flush the high here. If we draw the ABC pattern, ABC, flushing down to $21.91, but I don't think you maybe get that low. I think you may just come down to 23. But again, head and shoulders, like, theoretically, yes, it is, but I don't see it acting the way I would expect it to act. On top of what I don't like about it is the very flatness of these shoulders. Usually you want something a little more jagged. You want a higher defined peaks in those areas. So it could just be that they had news, catalyzed, came down basically to the same area. People had accumulation here, finding support essentially. And if you look at the monthly, there's not a lot of price structure here. So again, this is all relatively recent price structure. He made a monthly lower low on the close, but failed to take out the lows of the previous month, so that's bullish. So there's bullish and bearish signs here. I can't tell you if it's bullish or bearish just because you have to let it play out. You have to let this play out, see what it does around these upper areas of here that you haven't been able to get above, basically 38 on the dot. Push back above there. You have a lot of price structure that's very easy to get through here. And I would be looking at that resistance around the $42.67 area all the way to $43.70. That's where I'd be looking for that selling pressure to come back into effect. And that's just, yes, I do see the head and shoulders. Do I think it's going to play out? No, especially you have earnings coming up. If you're running into earnings, you hold past earnings in the sense of hold as.
When is earnings on Jackson, by the way?
Let's see. It is Tuesday next week.
All right, Tuesday next week. All right.
Not next week, correction. Tuesday the following week.
Gotcha.
Not this coming week, but the following week. So really, it's going to come into, do you run into earnings, which I don't necessarily like. You guys know my opinion about running into earnings. Kind of sets you up for failure. But if it has a really good earnings result, I could definitely see it coming up, pushing up into the 44s and going from there. But other than that, you got to let time play out. Like I can't. People can come tell you it's bullish. People can come tell you it's bearish. I'm going to tell you get a 50-50 shot for both. That's the most clean advice I can give, or opinion, I should say, on the company. So.
All right, cool. So let's actually go back to his comment, because this is a pretty loaded comment. He also goes on to say, also on the live streams, you mentioned selling Microsoft earlier in your investment career. You stated you become smarter and always traded options, and also traded options in the other, and the other gentleman concurred. Yes. So with me personally, I actually started investing when I was 21. Remember, it was February. It was around like my birthday, like February or something like that. And I started buying companies, and I owned Microsoft for a little bit. And I only bought like 2 shares because I was a college student. So but Microsoft back then was, I kid you not, $80. It was like crazy. And when you first start, you always have the mentality, you're always told buy low and sell high. But aside from that, I really didn't have anything. And then a few I guess months later, I discovered options, and I started buying call options, thinking, oh, okay, everything is fine, and it actually ended up being really, really bad. Like one of my call options, it was just awful. I remember it was on the Dow, on the DIA ETF for Dow. And that's
when the last time the Fed tightened.
That was the last time. Yeah,
that was our first experience of what it means for the Federal Reserve to basically come wreck your portfolio.
And did it wreck it for me? Back then, I used Robinhood, and I'm inexperienced, so I'm over here like buying options. And I'm like, oh my god, I made $1. Oh my god, I made $2, and I had no concept of dividend investing or anything like that. So yeah, I lost a ton of money when it came to that. Next, he goes on to say, I do extremely conservative call writing on my holdings. I built to 100 shares and sell puts on lower price companies like pins I don't mind owning, and has a decent ROI utilizing the wheel, basically the option wheel strategy. That's a strategy that I am aware of, though right now I only like selling the puts because I am of the opinion, my goal is to essentially build my dividend portfolio, and essentially the companies that I sell the puts in, either I want them to expire, or the ones that I'm like, okay, I really want to own this thing at like for example, I sold a put for T-Row not too long ago for a strike of 96, right? If T-Row would have fallen down to 96 and it would have expired in the money, I would have been like, I'm paying it the $9,600 because it's freaking T-Row and I love it at that price. It never hit. But nonetheless, though, that's something that my goal is to essentially just build my dividend portfolio, because that is the most passive form of income that I could think of. Because even with selling puts and selling covered calls, you still have to, it takes some kind of active investment for you to do. You get me? So the goal is essentially for me, dividends. Then he goes on to say, out of the 4-ish years I've been investing seriously, I've watched plenty of videos and have read a few books. Hopefully you have read the Creature from Jekyll Island. Because if anybody hasn't read it, I highly recommend y'all read that book. It's basically the creation of the Fed in 1913. That's pretty much it. So if anybody hasn't read that book, I highly suggest it because it really just show the monster that is the swamp monster that is the Federal Reserve. I like the info you provide, and it's also not boring. Well, thank you. I like to have a coaching call with you if you do those. I like to geek out on this stuff, and I want to become better at it. Thanks, Tony. So, and of course, the purple shades. So, Tony, that's not a problem. The thing is that right now, Mike and I, we both have a day job. Like we work. Not a 9 to 5, but like I work from like 6:30 to 3:30, and then from like 3:30 to I go to the gym at like 4 o'clock and then like from like 4 to 5, I work out, and then I come home. I have to make dinner, and then I have to and then I sit down to make a video. So I literally have no time. It's just it is what it is. And then during the weekend, I'm still working. During the weekend is the time when I have time to spend with my wife, as well as just make any extra videos that I may want to do. So this is on my end. We really have no time at the current moment to do any kind of calls or coaching calls or anything like that.
But the thing is, not to say like we wouldn't want to do stuff that in the future, but I really, for investing, the only way you're actually going to learn is to make the mistakes yourself. I know
by doing.
Yep. You have to basically.
And by the way, we still make mistakes right now. We're still making mistakes right now.
The whole thing about is
Warren Buffett still makes mistakes.
Management. Yeah, understanding risk management. Like
that's pretty much it. Yeah.
Like you hear us talk about on the channel that companies can go to zero. Any company can go to zero.
Boy, we really great segue.
Yeah. Well, not even that. Like screw FRC. Like if I'm not even referring to that. Okay. It's when people come on the channel and they basically say it has to do this, has to do that. Any company can go to zero. You don't understand history. Every time is different. Mentality is going to blow your portfolio up.
Exactly.
The same way it's going to blow your portfolio up this year because you refuse to look at history and learn from it. Yep. Everyone says this time is different until it's not. Yep. And that has been told to me by people that have been investing longer than me and him have been alive, put together, and basically Warren Buffett. Here's the thing. If everyone is wrong, right? There's one person that's probably not wrong or has a very high probability of not being wrong. He can be, but I'm not going to discount the fact that Warren Buffett's sitting on more cash than he has in almost 5 decades. And the guy and Charlie Munger that basically said cash is trash is doing the same thing. So either these two see a discount. You see people that have made it in the industry basically doing the same thing. And I'm actually going to use this as an example from work. We've talked about this on the live streams where we specifically the FRC. I had a coworker that has with a certain investment firm that manages the money. I have my own opinions of that, but everyone do their own thing, right? And I've been preaching to people that are 401ks and have basically IRAs that with their work, personally, I think it's a scam. I don't put much money into it. I manage my own stuff. But, if someone didn't know better, and the reason we say 401k is a scam is, are you expecting to pay more taxes in the future or less taxes? So why are you deferring taxes now to pay more taxes in the future on a larger sum of money? So, that's all I'm going to say about that.
That, by the way, is not a call for you to let go of your 401k. Absolutely not. No. But that's just our opinion.
Yeah, and there's a case to also be made if you want to make the case of company matches and stuff like that. Like, you sit down and do the math for yourself and figure out
what's best for you, essentially.
Yeah.
But in regards to, this whole thing. So, I would really like to eventually take the channel to like the next level. And I was just talking to Mike about this a few minutes ago. Basically, if anybody knows, I really like Tim Pool's format. Now, he mainly does political stuff. Obviously, I don't do political stuff, but I really like the format that he has, where he essentially just has like 3 videos a day where he reads the stories. of the day. And then at night at 8 o'clock, he does a live stream where he just covers those stories for anybody who couldn't see it during the day. And then like he has like an open kind of air podcast in a way. So that's pretty much what I want to take the channel to eventually. And obviously, Anthony, I know you're brand new, but like, I'm just going to say right here, the goal is to eventually move down to like Tennessee. And then pretty much like rent out an area in like North Carolina, somewhere in between Tennessee, East Tennessee, by the way, Tennessee and where Mike is, which is South Carolina. Rent out an area in like North Carolina, and then have like a straight up like studio format where we could do the live stream, where we could do the in-face or like the live streams with like people with, you know, like actual stuff, right? And not just like recording the screen when he does the technical analysis. So that is essentially the goal when it comes to that. That's essentially where I would like to take the channel. That's it could take a little bit, obviously. I mean, it really just all depends of how much support we get from you guys. And don't get me wrong, so far we got a tremendous amount of support, and we really do thank you for it. But that's essentially what I'm trying to say is like in the future, that's where I would like to take this whole entire live stream. Is I would like to essentially make it like my own company, right? I would like to, you know, be able to quit my job, do live streaming, have my own website, provide you guys like shirts, mugs, I don't know what else, pants, or like, you know, actual merchandise,
and actually do like stuff live with you guys.
Right.
Like, you know, people have Discord groups and they charge for it, which I think is the abomination of the world. If your portfolio can't provide you the income you need, then you need to find another thing to do, in my opinion. But
even when it comes to sponsorships, I've said several times in like several videos, I will never take any form of sponsorship outside of like food related stuff. That's it.
Yeah.
Anything outside food related, I am not doing, because I just don't trust them. I mean, look at what happened with what's it called? FTX. I was thinking FRC. Man, so many things start with F. But yeah, that's the reason why I will never take any form of sponsorship outside of like food related things, because I don't trust them, and I would rather give you guys tangible things like a mug or like a shirt or like whatever, a hoodie, than, you know, actually have the risk of another FTX happen to me. So no, absolutely not. But anyways, that's pretty much all I wanted to.
One last comment.
Okay, go.
Just to finish the story about what happened.
All right, go.
I was telling everyone in my work, I'm like, maybe you guys should invest in bonds. 401ks kind of have an option for that. And some people listened to me about it. Some people didn't. I'm like, look, it's everyone's their own choice. His own financial advisor calls and they say, hey, we need to put 70% of your portfolio in bonds. I'm like, some guy on the internet told you that 3 weeks ago when bonds were hitting all-time highs.
And the yield was going all-time highs as well.
Yeah, it was like on the 3 month was paying 5.2 at a point.
But all right, so we got 10 concurrent viewers right now on YouTube. So that's pretty much all I wanted to mention when it came to this comment. Again, thank you so much for the comment. We really do appreciate it. Now let's head over into the juicy stuff, because guys, well, yesterday everything was all great and dandy. We thought that it was over. The collapse is over. FRC was up a whopping 8%, right? 8%. It was beautiful. What's up?
Buy the dip.
Buy the dip. Buy the dip mentality, and it's over. Everything was fine. And I even covered a story here saying that if FRC doesn't, like, the likelihood of FRC doing something, I forgot what it was, is not likely, or like the government is not coming to the rescue of FRC. And I'm just like,
the government is not coming to the rescue of FRC.
That's it. So I'm like, great. So why is it up 8%? Well, guys, the party's over, because as of today, not hit zero yet, but take a look at this. Intraday, FRC 43.3% down. And on top of that, look at post-market. Post-market, where there isn't a lot of liquidity. This is not earnings. Yeah, this is not earnings. This is, this looks like it was done on like earnings day, wasn't it?
No. I that's the first time I'm seeing that.
Are you serious?
My jaw just hit the floor.
I'm gonna zoom in a little bit so everybody can see. Look at that, 43, and then 37. post market where there isn't supposed to be a lot of liquidity, anybody that
I gotta show you this. Let me show you the screen because this is something that I'm just blown away right now.
screen sharing.
Yeah.
All right, let me
if you see this, you have, if you look at just look at the volume, guys.
Hang on.
This is daily volume level or about here, and then look at the current volume.
What's up, Rich?
So what was that?
What's up, Rich? Good to have you here.
But looking at this, like you're starting to see hikes in volume, right? Like you set into the close, but then you just sent right down through
Look
high
at
volume.
that sell volume, though. My lord,
So,
that's crazy.
And it's like
I'm glad the class is over. I'm glad the class is over.
It's like it wasn't bad enough that you lost 48% of your money during the day. It's another 37% haircut, and it's a 37% haircut on a person that bought it on the close.
Yeah,
like look at this. They bought. Well, I think this is shorts covering. I don't think actually people. Well,
Who knows? Yeah, you say that, but you don't know.
I think a majority of it was shorts covering, but then it's like, oh, it closed. Okay, boys, send it down.
just crash it, dude. We're so going to gap down.
This could be funds. This could be funds dumping it because usually 401k funds they trade at 4 o'clock.
You think it was your coworkers? You think it was your coworkers' 401k fund?
I don't know, but all I'm gonna say is that
37. Look at that, dude. 30. Okay, it's gone up a little bit, but still, though, guys, FRC has officially become. Well, I mean, it officially became a while ago, but guys, $2.22. This is a penny stock. A penny stock. The technical term for it is any company under $5. So, congratulations, FRC went from a whopping $171.09 just this year to a penny stock. To a freaking penny stock. And on top of that, look at this. I also have a few stories when it comes to this. And this is the reason why they actually fell. First Republic stock swoon deepens and report FDIC takeover imminent. Well, there it is.
No crap. Yeah. It's like wait. It's like FDIC is like it fell 40% today. I don't feel like getting out of bed.
Oh my god.
I was like, Mom, do I gotta get out of bed?
Dude.
Okay.
All I know is that this is the fact. If the FDIC takes it over, that's it. It's gone to zero. It's over. People will lose all of their money, and it sucks because I actually know somebody. I feel so bad for her, but she put in $1,100 into FRC. Obviously, I didn't say to do it or to not do it because, again, I don't give financial advice when it comes to buying anything. But she was just like, she bought it around like $20. It's, yeah. If the FDIC takes it over, that's it. It's gone to zero. It will get delisted, and if you have any money in this thing, it will go to zero. So that's,
any wagers? 48 hours or 24 hours before that happens?
Notice when it happened, though. Notice when it happened. The same exact time that Credit Suisse happened as well.
Yep. That we were going into collapsing into the weekend.
Yep.
And then you had.
So I was about to say.
If this thing opens on Monday,
right,
it's going to zero.
I was about to say, like, oh, tomorrow when the market opens. Oh, wait, tomorrow's Saturday. Oh, wait. Oh, wow. Okay, so never mind then. Okay, so that's pretty much, I mean, when it comes to the whole FRC fiasco, I am so glad that yesterday it was over. FRC gained 8%. People thought, okay, it's over, and then 40%. I'm going to show one more time for anybody who just came in. 33.62% post-market.
No. Well, Chris P. So
what's up, Chris?
I have to disagree with you. It's not a gamble because a gamble would imply you have a probability of winning something. You have a probability of losing everything at 100% because, like, something waterfalling that hard.
Yep.
It's not. I'm like, I challenge anyone one time in history to show me a company fall 99% and recover.
I mean, don't get me wrong. Can it? Yes, because let's face it, possibility versus probability.
Warm in the sun tomorrow doesn't mean it will.
Right. And if this thing actually does recover, oh my god! But the likelihood of it happening right now, I just really don't see it. But, anyways, what's up?
Here's the question I have for everyone watching the chat: what happens when the next one goes?
Well, which one's going to be the next one? That's the question.
Well, we don't know. You don't know which one's the next one.
Is the contingent in? Here's the thing. Also, is the contingent? we originally thought the contagion was only for Silicon Valley Bank. Well, now it's gone to, well, maybe, we don't know yet, but a lot can happen this weekend. If FRC falls, the contagion has spread from SVB to now FRC. Then the next topic would be, okay, the contagion's only in the regional banks. Great. So what happens when Wells Fargo hits the fan? Because out of the 6 major banks, Wells Fargo is by far the worst one. So,
but I don't think it would be even. I would argue that USB, United States Bank,
or USB, actually, yep.
It has a lot of exposure to the commercial real estate sector, or commercial real estate loans. They hold. I was reading an article. They hold like a very large percentage, and with this last push down, they actually made a new low at $31. Mind you, this was post earnings, so they had they fell. Went sideways. They didn't have a recovery like any of the other banks, and then they broke the SVB low, and that was into the through earnings. Basically, what I call a dead cat bounce now, and if they start showing bleeding, that could trigger similar to like what we're talking about, the bigger contagion in the broader market. But here's the thing: if there's murmurings about a bank failing. And this is what's awfully similar. In 2019 and 2020, 2000 and 2021, you had no bank failures. Similar to how 06 and 05 had 0. And then 2022, you had 3.
Right.
And now 2023, if you're mirroring what happened in 08, you should have 120. So if the regional banks go, the whole economy is going to go with it.
Well, let's actually go on to the next story in regards to why this whole thing is coming down. But before we do that, let's actually, Chris, what do you guys think of Bank of America? I think that, honestly, out of the 6 banks that may make it out of this, assuming that the contagion spreads, the only 2 banks that are going to make it out of this is going to be JP Morgan and Bank of America. Mainly because Bank of America has like an IOU from the government being like, the government, I wouldn't say forced them, but the government encouraged them to buy Merrill Lynch in 2007 and 2008.
A loaded gun to your head.
Right,
but
a loaded gun to your head. But,
that's not forcing you because they didn't physically.
So, I've looked at their fundamentals. JP Morgan's a lot better than Bank of America. I've made a few videos on Bank of America, even when they did have earnings, I believe, last week. So, if you want, you can just watch that one. But Bank of America is one of those banks that I think that they're going to weather the storm just because those are one that's just, they're not going to let it fall. This is no way. But let's actually talk about what's making these banks fall to begin with. Now, obviously, one factor is the high interest rates, right? The high bond rates, the high bond yields. However, the main core as to what's causing those yields to go up, it is the fact that, Core's PCE, the price index inflation, holds steady as expected. Mike, you know more about this than I do since you love the PCE. I prefer the CPI. So what do we know about this, my dude?
So actually, there's 2 things that happened. The biggest thing, it was a tick higher on the previous month was revised. So it was because I forget this.
Well, actually, let me stop you. On a year-to-year basis, core PCE price index gained at 4.6, slightly higher than the 4.6 rate expected, but a tick lower than the 4.7 rate in February.
I think there's a typo in that article because they were expecting 4.5.
Also, the fact that it says 4.6 slightly higher than the 4.6. So, yeah, I think there is a typo in this article.
But
damn it,
before I forget.
Okay, yeah,
before I forget. The reason we're saying JP Morgan and Bank of America, as you step down, JP Morgan manages 3 trillion, JP Morgan manages 3.5 trillion, Bank of America manages 3 trillion, and then Citi, you have $1 trillion gap between them. So, and then it gets more exponential of what they manage.
Yep.
So your basic
with Wells Fargo all the way at the bottom, by the way.
Yep. So you have basically, let's see, core PC prices for month over month came in at 3.3, expected 3.3, last month 3.3. But I thought inflation was going down.
Right.
Core PC year over year, 4.6, expected 4.5. The previous months got revised from 4.6 up to 4.7, which indicates a 2-month stagnation in PCE prices to only have them fall this month to the 4.6 number. So really, you either had the stagnation from last month to this month, or this month or last month to the previous month. Regardless, it's showing inflation is a little stickier than everyone's thinking.
A lot. CPI may be going down, but PCE is just not going down at all.
But that's also the Fed's preferred metric. This is what the Fed's going to look at, and they're basically going to say if 1 + 1 doesn't equal 2, we're not pivoting.
Yeah. And, well, you can see that all of this is bad news, right? We got FRC collapsing, possibly the FDIC taking it over. We got sticky PCE. And how did the market actually respond to all of this? Well,
you got one more bad news. You got unemployment wages going up 1.2%.
Right.
Employment wages going quarter over quarter, up 1.2% versus 0.9 expected. And they revised the last quarters from 1% to 1.2. So they're basically saying you had 2 quarters of an increasing wages, wage price spiral, QE, Federal Reserve's worst nightmare. But the market decided the PCE, right? This is the flexible one where it's not the core. Core is very sticky, where this is the volatile one.
Well, PCE, month over month, PCE is
regular. Month over month came in at 0.1%, expected 0.3, so it had a drop. And then the year over year number, previously it was 5.1, which was revised higher from 5, but then it fell to 4.2 on the year over year number. So everyone's cheering that number. They basically, market's going to choose what it wants to run on, right? But the Federal Reserve is not.
And did they cheer? Because this is the S&P 500 index, guys. Intraday, 0.83. So essentially 1% on the freaking day. For what? For what? This is the exact same thing that happened yesterday. Why is FRC up 8%? Well, because the collapse is over. Apparently not, because I just showed you guys 30% down post-market. So why did the market go up today 1%? By the way, this is not just isolated to the S&P 500. We got 0.7 for the NASDAQ. So again, pretty much 1%. And the Dow Jones 0.8 as well. So it's like, what is happening here? Why is the market going up with the fact that the FDIC is going to take over FRC? The contagion's not contained, I guess. And PCE came in at a lot stickier than what people thought of. So this is what you call irrationality to like no end. This is stupidly irrational.
One of the guys I follow on YouTube, Mike Schwartz, if you guys want to go find his channel, I think he's a very intelligent person. He talks about how in 2008 he put the largest trade of his life on to only lose it in the next 3 days. And this kind of reminds me of, he talks about it. This market reminds him of what was happening right coming out of the first drop in 08, where everyone thought everything's okay, new bull market. There was just, markets only go up, but like all this stuff you hear.
To the moon.
Yeah, but the thing is, like, the other thing that I'm looking at that I've basically used as a gauge for, am I losing my mind? Am I not seeing something? Net speculative positions have not been this short ever since 2011.
Do you have that up or something? Do you have that up? Or
I can actually send it to you.
Oh, so well, I mean, if anything, well, yeah, but that's just going to bring up more problems when it comes to the live streams. So we probably should have had that up prior. But you said net speculative positions are what?
So net speculative positions are basically the
shorts.
As it's not shorts. It's telling you what the balance book is. So the amount, if more people are long the market versus more people are short the market. And ever since June of last year, they've been short the market. So they're in a pain train and they're adding more to it. So either they're very, very dumb and they're going to get obliterated, or they're very, very smart. And I haven't made up my mind which one it is yet, but I do think that both sides are getting pretty over leveraged. I do think the bulls are getting a little more over leveraged than the bears, just because you have debt ceiling issue, which could be a nothing burger. I don't think that's going to be a catalyst, right? What I do think is a catalyst when banks start failing. Like,
which FRC?
Well, here's the thing. It's like banks fail all the time. Yes, but they don't start domino affecting one to the next. Credit Suisse, which is a STIG. Significantly important global institution. So you have that. Those don't fail. Like, there's a reason they don't fail. And you just had that. And then you had SVB. Then you had FRC.
Well, you're going at FRC. But yeah, I honestly think that we are just going to see a lot more blood on the streets when all these things just come to an end, because there's no rhyme or reason for this to happen. Now, with that said, guys, let's head over into some, I guess, better news. Kind of, not really. But let's head over into some of these earnings, because, as I said, we did have earnings today. And, well, only two companies had earnings, ExxonMobil and Chevron. But I want to cover, guys, ExxonMobil first. So let us get started. Let us get started with the earnings when it comes to ExxonMobil. And, first things first, guys, we're here to make money. I don't really care if you guys are pro-oil, anti-oil, whatever. We're here to essentially make money. And this concept of moral investing, there is no such thing. Now, when it comes to me, I personally love my oil companies, and you're going to figure that out why when we cover Chevron. But for now, let's cover ExxonMobil. So looking at these earnings, if I can find them, let me see. So ExxonMobil, guys, had earnings of $2.83, beat by 23 cents. EPS gap actual of $2.79, beat by 25 cents. Revenue actual of $86.56 billion. Look at that miss, though. Look at that miss when it came to that revenue, Mike.
Wow.
3.5 billion. Now, does this mean that ExxonMobil completely listen, be quiet. Does this mean that ExxonMobil is just absolutely collapsing all this stuff? No, because at the end of the day, these revenue expectations is from analysts. What we want to take a look at it is their year over year, is that growing? Because that's really what matters the most. So let's come into their actual earnings report. We got ExxonMobil announces first quarter 2023 results. Today announced first quarter 2023 earnings of $11.4 billion or $2.79 per share, assuming dilution. Results included unfavorable identified items of approximately $200 million associated with additional European taxes. Damn, those European taxes. On the energy sector. I wonder why. Probably because, guys, there's a lot of attacks when it comes to the energy sector. There really, really is. And it's sad because, well, I mean, we saw what happened in 2020 when oil demand, well, actually, we saw what happened recently when right now there's a lot of oil demand, and yet there is no oil. The supply of oil is just super, super low. Gas prices are going up tremendously.
And the cartel decides to say, spigot, we're going to close.
Exactly. And I love the fact that you just said cartel. Capital and exploration expenditures were $6.4 billion, on track to meet the company's full year guidance of $23 to $25 billion. Okay. All right. So I need to zoom in all the way when it comes to this. So delivered record first quarter earnings of $11.4 billion. We already got this. Increased oil and gas net productions by nearly 300,000 oil equivalent barrels per day versus first quarter 2022, excluding, why don't they say what they did in 2022? Excluding divestments, entitlements, and I have no idea how to say that. Sakhalin 1 exploration. Again, I don't really know how to say that. Started up the Beaumont refinery expansion and reached full capacity of 250,000 barrels of production per day to help global demand. Great. Announced final investment decision for the Euro? Okay. Euro? No, is it Euro? Offshore development and 2 new discoveries in Guyana. Grew low carbon solution businesses with the execution of new long-term customer contract for carbon capture, transportation, storage. So you can see that it really wasn't that bad. Now, here's what we got when it comes to their results summary. And when it comes to the earnings per share, I'm going to have to zoom out on this one a little bit. When it comes to these earnings per share, where is the... Why do they have the financial highlights like all the way here at the... Okay, this is very, very strange. This is honestly very, very strange. But we can see that...
Unique.
What's up? Well, they're making my life more difficult. We got over here, guys, earnings of Q1 2023. It was $11.4 billion. This isn't billions. Q4 2022, it was 12. So it was actually a decrease quarter over quarter. However, Q1 of 2022, sorry, $5.5 billion. So Q1, the change versus the Q1 2022 change was $6 billion to the positive. However, the change versus the Q4 of 2022 was a decrease of was a decrease of $1.32 billion. Earnings per common share, we pretty much just saw this. Let's see over here. Earnings when it came to the excluding items, so non-GAAP, went from 11.6 to currently now. And Q4, it was 14 billion. So once again, another decrease of around 2.42. Q1 of 2022, 8.83, which was an increase of $2.8 billion. And you can see here, capital and exploration expenditures has gone up. However, it's actually gone down from Q4 to Q1 by around $1 billion or so, going from 7.5 billion to 6.4 billion. And the change in regards to Q1 of 2022, 4.9 billion to 6.4 billion. That is an increase of Yes, sorry, that is an increase of $1.5 billion. Now, let's take a look at what the CEO had to say. Quote, our people's hard work to execute on their strategic priorities deliver a record first quarter following a record year, said Darren Woods, Chairman and CEO. We are growing the value by increasing production from our advantage assets to meet global demand. At the same time, our low carbon solution team is rapidly growing this new business with an additional carbon capture, transportation, and storage agreement that underscores the company's growing momentum in providing industrial customers with large-scale emissions and reduction solutions. Okay, so far we've pretty much seen all positive things, right? Nothing's been too negative. They've opened up a new facility. They've reached peak number of barrels in another one. So all of it's pretty good so far. Yet, let's actually come down here because I did notice this while I was scrolling down. Again, you guys can pretty much read all of this if you're watching the video. But we got over here, cash flow from operations totaled $16.3 billion and free cash flow was $11.4 billion for the quarter. The company's debt to capital ratio remained at 17%, and the net debt to capital ratio declined by 4%, reflecting a period end cash balance of $32.7 billion. What I want to take a look at though now, it's mainly the graphs, unless, actually, shareholder distributions of $8.1 billion included $4.3 billion in share repurchases. Absolutely love it. Keeping the company on track to repurchase up to $17.5 billion during the year. Okay, so they're going to continue to buy back shares, guys. And you can see that, you know, $4.3 billion in share repurchases. They still have what is that? $13 billion left. Right, when it comes to this year. So yeah, you guys are going to see a pretty good change when it comes to the shares outstanding. So if you own this company, you're going to get a nice bump when it comes to the shares that you already own. The corporation declared the second quarter dividend of 91 cents per share payable on June 9th to shareholders of record common stock at the close of business of May 16th. So the ex-dividend date, May 16th. So we're going to take a look at that when we get into the calculator. But nonetheless, though, they are still continuing to issue a dividend. And I believe that they have not cut it either. So that's really, really good. Now, let's head over into the graphs, though, because if I really just want to see the revenue, this is a massive, guys, look at this freaking thing. This is a massive, like just entire freaking earnings report. So this is what I'm talking about, that you guys definitely have to just read it for yourselves. So I'm going to put over here revenue to see if I could actually find it. I just want to find that. There we go. This is exactly what I wanted. Okay. So we got, guys, total revenues and other income in 2023 so far. Again, this is just Q1 of 2023, $86.5 billion. In Q1 of 2022, $90.5 billion. Not too shabby, right? Not too shabby. The fact that in one quarter they did 86.56, and in Q1 of 2022, sure, it's lower, but it really isn't that bad, honestly, by around $4 billion or so. Let's actually see if we can find anything else when it comes to this. See if you can find Mike net income, if possible. We got other income here. Income from equity facilities. Well, I mean, the income from equity affiliates was $2.5 billion, and now it's $2.4 billion. So that's a decrease of around like $100 million or so. Let's see. If I don't think. Let's see. You can see here that their dividends in common stock did go down, so that's actually really good. Do you know why that's really good, Mike?
Because they are buying back shares.
They're buying back shares. So that's why they're issuing less and less dividends. So that's actually really, really good to see. Let's actually see. So millions of common shares outstanding, going from, look at that. Look at that. So this is, once again, 2022 to 2023. Look at that share repurchase. Where was I? Hang on. Where was I? Did I miss it?
No.
Where? Do you see it? Right here.
There.
Right here. Sorry. We got 4.3 billion shares outstanding, guys, to 4.1. So really, really nice share buyback. And yeah, this is, again, there's a lot more when it comes to this entire earnings report. But once again, you guys could just read it for yourselves. The link will be in the description below. So
and that's nearly 5% of their shares being bought back
in just 1 year. So let's take a look, guys, at the calculator. Let's see if the current share price, this is looking like a buy. We got the ticker for XOM, market cap of $480.4 billion, a PE of 8.93 with a current share price of $118.34. Now, looking at this company's, guys, we can see that on the 1 year, they're up 35.71%. But then again, what oil company isn't up in freaking 2021 through 2022? And on the year to date, we can see that it's still up 11.11%. 52-week range is $80.69 to a whopping $120, guys. We are at near all-time high. Well, at least 52-week highs. So by this metric alone,
you made new all-time highs
today. Oh, is this new all-time highs? Okay.
Yep. All-time high of $119.92.
So that is all-time. Okay, great. So we are essentially near all-time highs when it comes to this. Now, based off of that alone, I don't like buying companies that are at all-time highs just because it's like, it doesn't feel like it's just,
you're paying a premium.
Well, you are and you are not. It just depends as to what you're getting for that kind of price, right? Because every investment is the present value of all future cash flows. So the PE is telling us that it's a really good price, but the PE is only telling us what the earnings is. And they've been having some very good earnings these past couple of years, right? So it doesn't really tell us much. Let's use discounted free cash flow when it comes to this. They do pay out a dividend of $3.64, which is a yield of 3.12%, a payout ratio of 25.25, with a 5-year CAGR of 3.05%. So it's not that big. The 5-year CAGR, guys, is essentially how much the company has grown this dividend in the past 5 years. 3.05%, not a lot, but they have grown it for 20 consecutive years. The dividend aristocrat cutoff is 25 years, so they still got 5 more years to continue paying out this dividend. Fortunately, though, it's unfortunately still not a dividend aristocrat. Ex-dividend date passed as of February 13th. Payout date was on March 10th, and they pay their dividends quarterly, but we just read their earnings report, and we saw that they are going to issue another dividend starting, the payout will be in June. Now, here's something that I also wanted to talk about in regards to just Exxon as a whole. So let's come back to this graph, guys, because, well, obviously we knew what happened in 2020. The lack of oil demand was just plummeting to the point that, well, there was so much supply, the demand was so low that oil prices went negative. And when it comes to oil companies, companies that mine the oil, they follow the commodity price almost to a T. So the same applies to that of gold miners or whatever kind of mine. Any commodity-based company, they will always follow their respective commodity, either that be wood, or lumber, oil, gold, iron, etc., etc., etc. They will always follow their respective commodity to a T. And if you guys actually take a look at oil prices back in 2020, in fact, I'm actually going to do that for you guys right now. If you guys take a look at crude oil prices back in 2020, we can see that, right here, boom, look at that massive collapse. In fact, it was so swift that I can't even look at it, but you can see that my mouse is hovering at like $10 right then and there. It went to the negative. It went into the negative. Negative $35. You just heard it. Now, as I just said, oil or commodity-based companies follow their respective commodity. Therefore, guess what happened 5 years ago when it came to pretty much every single oil company? They took a massive nosedive. In fact, prior to COVID hitting, ExxonMobil was around like $70 or so. COVID hit. It went to a low of $32 per share. Absolute insanity. I believe this was the all-time low. or no, it was around like 30. It was around between March 20th to around December 2020. If you bought around this kind of area, guys, you are sitting so pretty right now. And yeah, that's very interesting. So the fact that we're seeing this, be prepared to see a lot of fluctuations when it comes to this company 3 years ago. Okay, Mike, so just keep that in mind. Now, with this dividend of $3.64 and their current shares outstanding, they pay out almost $15 billion in dividends every single year, which after this is paid in regards to the 5-year average free cash flow, they still have left $7.86 billion as of their last year's free cash flow. Look at that number.
Jesus.
So the dividend is paid, the $15 billion in dividends paid, they still have left $43.5 billion in free cash flow. Last year alone. So, yeah, they did really, really good last year.
That was the year that oil spiked to 130
yes,
a barrel,
it was.
120.
Yes, it was.
So take that with some grains of salt, as I would say.
Absolutely.
However, if you look at the 5-year, it's still impressive none the other.
Oh, absolutely. And look at these payout ratios in regards to the free cash flow. 25.45 for the last year's free cash flow and 65.38. So the 5-year average one, it's a little bit above what I like, which is 60%. But the last year's one is it's looking really, really good. So let's jump into these fundamentals now, shall we? And I forgot to change them, unfortunately for me. But we got the net income. I always forget to change them. We got the net income of $20.84 billion 5 years ago to 1 year ago of $55.74 billion, increase of 167%. With an outlier year of course, 3 years ago. Now, as I said, this was COVID related. So it's explainable. You can pretty much ignore it. What would you give this as a grade?
I'm going to say 70, just because ignoring COVID, right?
You can pretty much ignore the 3 year ago value.
2 to 1. It's a little concerning, but then again, I give it a higher grade than, let's say, other companies we would give a grade like this to, because...
Yeah, but also see this decrease from 5 to 4. 20.84 to 14.34.
But also, you're dealing with a sector that's very volatile.
That's very true. That's 100% very
oil true. Historically wasn't this volatile until probably 2016, the turn of 2016, where you had the big swings down, big swings up. And now, especially with OPEC basically being the cartel that's going to cut production anytime oil sees 70 in its sights, they're basically going to say, like, no, we don't want oil below 70.
But here's the thing, though. 4 years ago, this was 2019. You can see that 2019, oil remained roughly steady at around like the $60 mark, $55 mark. So the fact that they did go down is a little bit concerning, to say the least. So.
Correct, but they could have also done expansionary to drill more oil or different things.
That's a fair statement. You want to stick with your 70%?
Yeah.
All right, 70% it is. Let's move now into the free cash flow. We got 5 years ago of $16.44 billion, 1 year ago of $58.39 billion. That is an increase of 255% in their 5-year average free cash flow, with an average of $22.72 billion. Guys, I mean, once again, we see the negative, right? 3 years ago, perfectly understandable. Now, this drop from 5 to 4 is a lot bigger, though. It's a lot bigger than that of the net. Well, actually, is it? This is what, $6 billion, and this is, yeah, no, it's definitely a whole lot bigger. Yeah, it's definitely a whole lot bigger. So, and also the jump from 4 to 2 is even bigger. So, what would you give this as a grade?
The problem, I want to give it a little better grade just because the 2 and the 1 are showing a trend to the upside. I don't like the jaggedness, so it's almost like
but the 2 and the 1 are also in a position where, how can I say this? There is massive, huh?
You have elevated oil prices.
You have a lack of supply.
Yep.
You have a lack of supply, and OPEC even said that they're going to, also add this to the mix as well. I did not think about this. A lot of countries are talking with OPEC and being like, we don't want to trade oil in US dollars anymore. So what is that going to do, right?
Yeah, it could create some madness.
It could create some madness. Now, that's mainly affecting the US dollar, but, the petrodollar is a thing. So this is part of the petrodollar. So that may have a major problem as well. So what do you think about this? Grade, final
Well,
grade.
60.
60? Okay.
Yeah.
All right. All right. I'm not going to
Because
say anything. I'm not going to say
because
anything.
I
Next time
see
we
a
do.
benefit
Yeah, what's up?
to I do see a benefit to if a lot of countries get away from the dollar for buying oil in specific. You could force the hand of the United States to have to turn to its domestic producers, and that would bolster a lot of capital going into Exxon, Chevron, all
Drill,
those
baby,
local.
drill.
You got to
Drill,
think on the
baby,
flip
drill.
side is if you shunt the whole world, then you have two reactions. You either turn to your own producers or you force the world to give you oil. And
And
the
that's a
easier option
problem.
of the two is
Yeah.
drill, baby, drill.
Drill, baby, drill. Love it. All right. Looking now at the revenue. We got 5 years ago of, hang on one second. We got 5 years ago of $281 billion to 1 year ago of $402.2 billion, increase of 43.11%. Once again, here's something also. Look at this. You're seeing a constant decline in every single one of these profit metrics from 5 to 4 to 3. Ignore the 3. But from 5 to 4, you're seeing a pretty decent decline on the revenue, on the free cash flow, and on the net income. Very, very interesting to see, though. All right. So what do you think about the revenue?
Consistently increasing 3-2 to 1, even though you have the dip. I'm gonna say 65 just because in line with its the previous grade.
The previous grade. All right, all right, all right. Looking now at the assets minus the liabilities. This one's actually looking very, very interesting because it's flat. Like it's literally flat, except for what happened 3 and 2 years ago, which again, COVID related. Sure, okay, 2 years ago, 2021, we were still feeling the effects of the lack of oil demand, right? So that explains that. But look at what happened. I mean, 2 years ago to 1 year ago, $175.7 billion to 202.4 or 202.5. So that's massive. That's a major, major jump. And pretty much in line with even the 5 and 4. Look at this 5 year and 4 year goal number. It's almost exactly the same.
And they are saying like the 1 year jump to 2 to 1 is explainable because that's their Baytown expansion.
Right.
They've been investing in themselves, especially in Baytown, growing assets.
Well, that's mainly that's sure. Okay, yeah, the growing in assets. But remember, when it comes to growing the company, free cash flow is what's used for that. All right.
Correct.
It's a free cash flow. So we got average total assets of $354.5 billion. Average liabilities, it is $165.7 billion. Doing this difference, we get $188.74 billion. That's a lot of money. What would you give this as a grade? By the way, hang on. Shout out to the 12 concurrent viewers on YouTube. Thank you so much. We really, really do appreciate it. We really weren't expecting that much. I mean, yeah. Thank you so much, guys. We really, really do appreciate it. So what would you give this as a grade?
I would say 95 just because it's a small drop, but they're keeping their balance sheet basically flat. So they're not benefiting. They're not necessarily benefiting, but it's very concise, as I would say. It basically they're not changing your expectations. So it's almost like it provides safety for you versus being like, well, they're going up. Are they going to stay up? And they're like, hey, status quo, status quo.
Right. Status quo, status quo. Looking now at the cash flow minus the liabilities. Now, this one yesterday caught you by surprise by a lot of companies. But yeah. Here, guys, we got a very interesting looking graph, right? The lowest point being COVID, negative $171.2 billion. And ever since then, look at that consistent increase, though, back to zero.
Yep.
So that's very interesting, to say the least. But then again, this is actually pretty closely following the free cash flow. So you can see the free cash flow decrease, and then increase, right? So pretty much decrease, increase. So it's fairly following the free cash flow. So, even 1 year ago, negative $108 billion is a lot, significantly below the average of negative $139.2 billion. So what would you give this as a grade?
I was going to say 55 because you didn't have that. The decrease is a little concerning, but they're building it back up. So it's like, okay, let's see one more year of it, and then the trend really shows nice.
Yeah. Looking now at the shares outstanding. Now, we did see in their earnings report that they still have a whopping like $13 billion or $14 billion left this year to repurchase back shares. And this company is not consistently buying back shares, but very consistent. Well, pretty good at doing it, right? We got 5 years ago of $4.2 4.37 billion shares to today of 4.082 billion shares. That is a decrease on the 5-year. Not a lot though, but a decrease nonetheless of 3.66%. And from the previous year to the current year, 2 years ago of 4.239 to 4.082, that's a decrease of 3.7%. So, aside from the 1 year from 3 to 2, which they increased it from 4.233 to 4.239, very consistently decreasing it. So what would you give this as a grade?
95.
95. Yep. I agree with that. I fully agree with that.
Also, you gotta think about it. Their business model or their entire business sector is changing, and they're basically saying like we're taking the cautious approach. We're basically have cash on hand, have liquidity, and basically once we prove that we don't need it, then we basically return it to investors. So we always have that cushion.
And again, share repurchases affects the investor. I guess you could say it's like a double whammy. Because not only do they pay out a dividend, which we love, or at least I love, and I'm pretty sure all other dividend investors out there also love, but when they repurchase back shares, that's increasing the value of the shares that you already own, right?
Yep.
But at the same time, it's also giving them the ability to afford the dividend that they're currently paying, but even increase it, because that's shares that they no longer have to pay out a dividend for, which is why their dividends is actually going down year over year, even though it's actually consistently increasing, right? So It's like a double, triple whammy if they buy back shares and they issue a dividend. This is why you want to find companies that are buying back shares. I would argue more aggressively than this, but I'm not going to crucify them for that, and pay out the dividend as well.
And
lastly,
also,
what's up?
The quadruple whammy, I would say, is that they're making it harder because there's less shares out there. There's not as easily ability to manipulate the stock.
Right.
And when I say manipulate, look like Berkshire Hathaway being a stupid several $100,000 value.
That's
because there's not a lot of shares out there that people can buy and sell.
Exactly. And that's actually one of Warren Buffett's reasons as to why he doesn't like issuing or even buying back shares, because he's just like, no, I don't care if the stock price is $1 million. We want people here that are true
investors.
That are not going to trade the stock. No offense, Mike. But are going to be long-term investors on it. So I really like that too. So looking at the cash and equivalents, which is the last metric, they currently hold $29.64 billion with an average of $12.76 billion. Now, these overall grades: net income is 70%, free cash flow 60%, revenue 65%, assets minus liabilities 65%, cash flow minus liabilities 55%, shares outstanding of 95%, overall grade of 71. The main problem is the free cash flow and the revenue, right? But I mean, yeah.
It's an evolving sector.
It is.
Well, and when I say evolving, it went from being bearish on oil to neutral on oil to crash on oil to bullish on oil to massive bullish on oil to craziness to the merry-go-round of crazy went through this sector.
And again, guys, when it comes, I can't stress this enough. When it comes to commodity-based companies, they follow their respective commodity to a freaking T. It's not even funny. Like, it really isn't even funny. Unless there's like a major acquisition in like the company, or unless there's like a major spin-off or merger or something along those lines, they will follow their respective commodity to a T. So with these grades, let's figure out, guys, if at the current share price, which is at near all-time highs, is this the price to buy this company at? Because, well, Chris, if you're still watching, I know you want to know this. But I'm going to have actually Mike input all of these numbers. And guys, with a required rate of return. Wait, why is this telling me 94? Oh, wait, why is this telling me 94? Oh my God. Stupid calculator. Hang on a minute. There we go. Why is this telling me though $94? Because it's because I hit it to the other one. That's right. I forgot that yesterday. I changed it over to see what the dividend was. Yeah. But anyways, guys, I'm going to have Mike tell me revenue growth assumptions and predicted share buyback assumptions in the next 5 years. However, with a required rate of return of 10%, we got $91.33, not adjusting for debt. And let's hear it. Chris wants to. Okay, Chris, let's hear it. And then adjusting for debt, it is $94.36. Okay. I'm not telling you guys what the company is going to, what the share price is going to. That's not a thing. Okay. I'm telling you guys what the company's intrinsic value should be.
And Necrostalker asked, wouldn't Exxon follow natural gas closer than oil? No, and yes and no.
Knowing yes, yeah.
So natural gas isn't its primary business. It's mainly, I would say, 95% oil. Natural gas. Remember, you have the Freeport facility that's coming back online. So that whole sector, natural gas in the sector, is basically there's a split between it because natural gas isn't very necessarily valuable. Liquid petroleum is. So
Well, natural gas is valuable, but in comparison.
yeah, but it's what the whole drive behind natural gas. I've covered that on the channel a couple times, especially with like UNG and nat gas. It's seasonal. It's not like oil, and oil has some seasonality in it. Don't get me wrong, but natural gas is like heavy weather driven versus oil that's more like economical driven. And Exxon is big in the refinery world. The natural gas is about 5%. When you crack oil, you get 5% or on the top end. So it's not its main source of income or value stream, basically. And that natural gas that they produce, they can use it to feed feedstocks. They can use it in reactions. They do so much with it that they don't have to take a open market hit from it. They can basically do it all internally. They can use it to fuel vacuum furnaces that basically crack oil into four components like vacuum heating oil, heavy, light, all this other stuff. But before I go on a tangent with that, oil is their primary business. They may take a site, and I mean, I don't know really any trader that trades Exxon that looks at natural gas. They mainly look at the oil prices, like we just mentioned, and they trade based on the oil prices, and their whole business revolves around the oil. It is a sector, that piece of their business, but it's not their core business.
Right. So, unfortunately, the calculator is being really stupid. Google Finance is being really dumb. But nonetheless, though, we can still input some of these revenue growth assumptions. All right.
What are they saying? What's the estimate they're saying?
What is the estimate? Let us find out. So for ExxonMobil Corporation, revenue forward estimated 7.66. Okay. Do you want me to bring up the earnings? Sure. The earnings? Oh man, oh my god. Their earnings are just so weird. Oh my god. The earnings are just so, it's so bad. It's like
Control F revenue.
Yeah, I'm about to just do that again, honestly. Because it's not concise at all. For God's sakes. All right. I mean, it's a decline. It's a decline by around $1 billion. I don't know the percent on that one. So, actually, no, sorry. The decline is about by $4 billion. I'm sorry.
Okay, so about 3-point-something%.
Okay, yeah. And again, they're expecting to grow at 7.66. So what do you got?
Low assumption, let's say 4%.
Okay.
High assumption 8.
Okay.
8 and then 12.
And then 12. Okay. And the projected share buyback in the past 5 years, as you just saw, they've been buying back around 3%, 3.6.
So 5 years, and now they got a little more aggressive. So let's say buyback 3%
for the low one. Okay.
Yep. Buyback 5% and buyback 7%.
7%. All right. And with this, guys, we got the target share prices of $108.42 to $147. Let's face it, $150. Wow. $147.96 for the lowest to the highest assumption. And then adjusting for debt, this goes up around $3, roughly $3, $111.54 to $151.21. So, with a margin of safety of 5, 10, and 15, this is between $94.81 to $143.65. As you can see, we are, except for one of them, well, not including the margin of safety, only one of these is actually under the current price. So, yeah, I mean, the margin of safety, we have pretty much all the low ones are out of the picture. The medium ones, we can see that I would argue that 117 to 118, there really isn't much difference there. So, it's pretty much equal. 123 is looking good, and pretty much all of this is looking really solid. So, by the looks of this, guys, this is telling me that ExxonMobil, even though we are all-time highs, they are still a good buy right now. Does this mean that you go out and buy it? Absolutely not. Because at the end of the day, this is not financial advice. Every investment is the present value of all future cash flow. And I give out all these calculators for free. And the links to all of these earnings report will be linked in the description below as well. So, the best way that you guys can help us, of course, by, like, subscribing, commenting, guys. Thank you so much for watching the live stream. We really, really do appreciate it. And it's an interesting looking company, to say so the least. It's just, I would argue you have to make you would have to do a lot more research and also figure out what happened 4 years ago to make all of their profit metrics drop massively 4 years ago. Pretty much the COVID one, that's explainable. What happened 4 years ago? Not necessarily. So, yeah, this is pretty much it. It's not looking too shabby. Now, in regards to this dividend, though, let's see. Putting in $5,725 at the current annual dividends per share of $3.64, this nets to $176.10. So, I like to buy, or at least I would like my dividend to be around $230 or so, but if they keep buying back those shares, guys, it's looking really, really solid overall. So I don't condone people buying companies solely for its dividend. And again, I'm not telling you guys to go and buy this company. All I'm saying is, based off of the discounted free cash flow, and of course, my own opinion, not financial advice, this company may be a pretty decent buy right now. But of course, please do your own due diligence. So now with that said, let's head over to the technical analysis voodoo magic to see what Mike has to say.
I was gonna say voodoo magic. Actually, you stole my damn line.
Well, I gotta keep you on your toes. So let's bring over the voodoo magic over here.
All right. So for XOM, just looking purely at the price action, that we actually covered this back on its last earnings, or 2 earnings ago, I should say. That looking at it, it has a massive A to B pattern that was actually confirmed when you traded above the swing point here. That I need to move because it is not correct. Swing point here. My apologies. So once you traded above the swing point of $113.87, which you did right here, you confirmed the A to B pattern. That projects Exxon up to $131.54. That doesn't necessarily mean it gets there right now. It's just a long-termer target that basically Exxon can go up and down, up and down. What do I see that's bullish on Exxon? You recently came down to your 50 weekly, strong bounce of it, retested to 200 daily, strong bounce off it, continued higher, earnings gap up. Okay, so now we're seeing more bullish signs. Now we gapped above the 50 and we gapped and go. Now, this is a big push with Exxon, basically with oil bouncing back, OPEC basically announcing, hey, we're going to keep oil up higher. And anytime you have this big type of move, you like to see this consolidation. Consolidation means you're digesting the area. You actually bounced off the bottom of the gap up candle, found support, and are continuing higher. This is all bullish momentum, and earnings are just going to probably continue this. Earnings is now catalyzing in my opinion. You create new all-time highs, blue sky breakout. You failed to hold it, but you're heading higher. If you look on the weekly, higher weekly, higher high, lower, higher, low, higher high on the weekly. So as long as you keep making higher highs, meaning you have to make a new all-time high next week above $119.92. And if we jump over to the Lux Algo, we can basically see that the MACD is, and I mean pinching, like squeezing like no tomorrow, getting ready to explode. RSI, same thing. Now, companies can stay overbought for a very long time before pulling back. We look at any tech company, you can see plenty of examples of those. But again, Exxon's not a tech company. So what can we expect? Basically, if you break above the swing point of the upper high, I do see continuation up at least to the $123 mark at a bare minimum. What gives me a little concern is that your MACD made a high point here at the $117 region, and now you got to swing pretty massively up to break this point on the MACD. What I would be concerned about is forming a MACD divergence where you make a higher high on price, but a lower high on the MACD. Same with RSI. But with Exxon's fundamentals and everything, and a lot of these targets pointing up into the $130 region, I definitely could see that happening, especially with oil trading very bullish right now, kind of having a inverse head and shoulders. On the weekly, we do have a strong buy signal. So the algorithm is basically saying up to the moon, and your RSI, once it gets above that 51 on the weekly, this is definitely going to be a strong push. And on the weekly, you can easily push up to the 125 or even into the 130 region, the same like the daily. So everything's green light in my opinion for a push up. Second you trade above the $120 mark, you're basically pushing up higher. That trend's going to light on fire and you're just going to be heading higher. Now if you stall out once you get to that $120 to $125 point, then I'd be looking for that pullback, maybe retesting this upper consolidation area somewhere between the 119 and let's say the 118. But as of now, in my opinion, it is an interesting buying opportunity. Even if you get a slight pullback here, maybe to that $116 region. But I necessarily wouldn't be looking for that. I'd be looking for higher continuation to the upside, especially having that earnings report. It wasn't really bad. It gave you a good chunk of profit. I see just the technicals basically saying we're most likely going higher, and we have definitely room for continuation, especially to that $123 region, or even let's say the area of $128. I would basically target somewhere in the middle of that reversal zone to be your like selling point or swing point that may be trimmed position. But anywhere down here, especially in this area of consolidation, there's a lot of volume that's going to be support in the future. It is going to be an interesting point to buy, and Exxon could stair step its way up to those higher price targets. And then next earnings comes out, you get more higher price targets if they increase cash flow or anything. It's definitely, even at these high prices, a very probable buy. And the trade is pretty easy. You break the gap right here at $113 a share. Then I would basically stop out, wait for more price consolidation to happen because you're going to fill this gap. You have a nice risk to reward, probably 2-to-1, where your downside potential, if you bought on the close today, I'm going to say is 4% to the downside. And at minimum to the upside, you're looking at least 5 to possibly 10%, depending if you have a stretch target. So closer to maybe the 1-to-1 ratio, but still an interesting opportunity where you can risk 1-to-1 or maybe 1 to 1.5. It really depends on what your appetite is. And you could be looking for that pullback, but not necessarily maybe getting it. And you may not be getting it back to these prices that you were here in this consolidation. So with that, we're going to go probably to the next company.
Yes, we are. So again, thank you so much, Mike, for that. And again, guys, when it comes to Chevron, when it comes to Exxon, well, I just, okay, I'm not saying it's a bad company. I just prefer Chevron. I just do. I just really, really do. And so we're gonna actually cover that right now. So let's jump over into now the second company. And of course, if you're watching the video, please, you guys will see the Chevron video in just a few hours. But here for the live stream, let's go into now Chevron. And all right, guys. So here's the reason why I absolutely adore my baby Chevron. Well, the fact of the matter is that I bought them at a really, really good price. In fact, I'm going to start off with showing you guys my portfolio if you guys have not seen that yet when it comes to Chevron. So let's come over here to holdings, and you can see right there it is. I am up a whopping 8,000. I know that's a little bit difficult to see, but I am up. Actually, let me just increase this a little bit. Let's see. Where is it? Right there. So there is that number. I'm trying for you guys to see it. $8,227.22 on Chevron alone. This is my best company to date, and it's because I was buying this company. Well, my average share price is actually about $101. So I was buying this company when it fell to around like the $60 mark. Didn't buy it then. Actually, one of my friends here that was just in the chat, Woodsman's TA Keck, Rich, he was telling me, dude, I'm telling you, man, oil at $60 it's amazing. Oil at negative 35 is amazing. Oh my God, it's crazy. Chevron was at $60. I'm just like, I don't know. I feel so bad. I don't know. What if it goes to zero? And then it started to pump. It pumped up to about like $100, and then it went up to like 110, and then it pulled back to 100. And I'm like, I'm pulling the trigger. I'm putting in $10,000 into this thing, which I did. In fact, I have invested $12,508. You guys can see right there, and it went really, really good. They even pay me, guys, a whopping. This is by far the highest dividend payment, $185.73 every single quarter. They pay out March, June, September, and December. So amazing company, amazing investment. It's absolutely amazing. And this is essentially the company that taught me, yo, when things are falling, you buy. Because if their fundamentals are actually really solid, and the price is not following those fundamentals, it's a good time to buy, and buy a lot, because most likely this thing will go up. I mean, we saw the same thing with Crocs, $76, and it went up all the way up to like 150 or something like that, right? So a lot of stocks, guys, are like this, and this is essentially the one that taught me to not be afraid, So let's go over, guys, now Chevron. So I'm gonna bring in all of these tabs because there's a lot of tabs. But Chevron actually had really, really good earnings. What do you have you taken a look at their earnings, Mike, or no?
No, not yet.
Not yet. All right. Well, let me just bring in over pretty much all the tabs, and here is the news. I found Chevron's fairly easy. I did not find ExxonMobil's too easily, but I guess it is what it is. Nonetheless, though. All right, guys. We are now going to start the stock analysis as well as the technical analysis for the company Chevron, my favorite company, as I just said. So, okay, they had earnings today, and their earnings was a beat. $3.55, beat by 14 cents. EPS gap actual, $3.46, beat by 10 cents. Revenue, $50.79 billion, a beat by $1.3 billion. That's absolutely insanity. Now, I didn't mention this for Exxon, but I am going to mention this for Chevron. You can see that in the last 90 days, prior to this revenue prior to this earnings coming out, they had 10 revisions to the downside. So yeah, they beat a significant amount. Does this mean that they're growing year over year? Not necessarily. So let's take a look now at their actual earnings report. And look at this. I'm pretty sure Exxon does this too. I just couldn't find it. When you guys see the video, I'll probably get the correct earnings report linked in the description below. But we got over here. Chevron reported earnings of $6.6 billion, adjusted earnings of $6.7 billion. Cash flow from Mike, what do I say? Mike? You're muted again. Okay, apparently he's not answering me. We got cash flows from operations of $7.2 billion, free cash flow of $4.2 billion. I absolutely adore, guys, when a company puts their free cash flow right there at the spot, because it's just absolutely amazing. I don't have to search for it. I love it. We got shareholder.
And they're proud of it.
What's up?
And they're proud of it. How
nice of you to finally join me.
Sorry.
Were you muted?
Yeah.
Damn it. All right. But seriously, though, what do you think of this free cash flow? Look at this. Free cash flow, $4.2 billion. We don't know what it was for Q2, though, so we'll probably have to take a look at that one. Or sorry, Q1 of 2022. Shareholder distributions.
It has to be good, because if they're putting it out there, it has to have a nice increase.
Or it may just be the format for the earnings report. Shareholder distribution, i.e., share buybacks and dividends, $6.6 billion, up 65% from the first quarter of 2022. Yeah. Shareholder distributions, they have increased their shareholder distributions 65% from the first quarter of 2022. That's I absolutely love Chevron. I really, really do. All right. So, Mike, we're both engineers. We both went to the same school. We both did the exact same major. So we pretty much know the jargon around this kind of thing, right?
Downstream, yeah.
So we got, guys, the earnings and cash flows. I know I love my cash flows. We got upstream in Q1 of 2023. By the way, guys, upstream is essentially when they take the oil up from the ground. Okay, so if anybody does know that, we got upstream $5.2 billion, and in regards to Q4 of 2022, $5.5 billion. And that's a big drop though. Q1 of 2022, $6.9, almost $7 billion. So that's a decrease of around $2 billion when it comes to their upstream segment. Downstream segment, which, by the way, guys, again, downstream, it is when they're refining it. All right. There's also a midstream one, which is the transportation, but that usually is specific to midstream companies. Usually upstream and downstream companies don't do anything regarding the midstream, usually. Yeah, the transportation. Downstream, though, this is where they made majority of this loss over here when it came to the upstream one. Guys, downstream, $1.8 billion. Q4 of 2022, $1.77 billion. And Q1 of 2022, 300. You want to read that?
331 million.
331 million. So look at that freaking change. That's awesome. That's absolutely awesome. And then all others, it was actually in the negatives, negative 387 million, but so was in Q4 2022 and then Q1 of 2022. In fact, it's actually getting better. So that's really, really good to see. Now, we pretty much just know all of this, the earnings, whatever. Cash flows from operations. Basically, the cash from operations. Guys, $7.2 billion. Now, sad to say, all right? Sad to say. Q4 of 2022, fortunately, $12.5 billion. That's a decrease of around like $5 billion. And then Q1 of 2022, $8.1 billion. So another decrease, unfortunately, but it is what it is. And CFFO excluding working capital, I think that this is the free cash flow. I believe this is the free cash flow. I hate when they word it differently. Q1 of 2023, $9 billion. It was down from Q4 of 2022 of $11.5 billion, but it's the same as Q1 of 2022 at $9 billion. So, I mean, I don't know how to feel about that. I really don't. It's just not changing. Quarter over quarter, though, is down, but I really don't care what happens quarter over quarter, really. Okay, let's take a look at the CEO's comments. We're delivering strong financial results and increasing cash return to shareholders, said Mike Wirth, Chevron's chairman and chief executive officer. The company's return on capital employed has greater than 12% for 7 consecutive quarters, and the company returned $6.6 billion to shareholders in the first quarter, an increase of 65% from the last year. Quote, at the same time, we're investing more to help grow future energy supplies, Wirth continued. We intend to leverage our capital discipline, advantage assets, and financial strength to deliver low carbon energy to our customers and superior cash distributions to our shareholders, Wirth concluded. The company increased its dividend per share approximately 6% in the first quarter and recently increased its target annual share repurchase rate to $17.5 billion. Thoughts?
Absolutely insane.
Dude, company increases dividends per share 6%. When was the last time you got a 6% at your job increase when it came to like a wage?
I can't remember.
Dude. And on top of that, this is money that you don't have to pay or that you don't have to work for. That's awesome. Absolutely awesome. And look at this. Increases target annual share repurchases $17.5 billion. 17.5. They're going to buy back $17.5 billion of their shares this year. That's insane. That's crazy. By the way, I do have this right. This is for April 28th, right? Yeah. That's crazy, man. It's absolutely crazy. Well, actually, we have the free cash flow. Actually, never mind. I'm so sorry. The CFFO without working capital, we do have the free cash flow over here. So let's actually go over this as well. We got return on capital employed, 14.6%. It's pretty in line with the Q4 and Q1. Capital expenditures, down from Q4 of 2022 by around 0.8. What is that? $800 million, right?
Yep.
That's $800 million. Q1 of 2023 was $3.3 billion. Q4 was 3.8, and up by $1 billion from Q1 of 2022. But that could just be, honestly, that could just be the inflation, right? That could just be inflation.
Or a change in oil prices or something.
Change in oil prices also work. Free cash flow, okay. $4.2 billion. Is this the same one that we got over here? Yeah. Well, unfortunately, you were wrong because they are going down in the free cash flow at least quarter over quarter. So Q1 of 2022 was $6.1 billion. Q4 of 2022, $8.7 billion. Q1 of 2023, $4.2 billion. Yeah. That's interesting to say the least. Now, again, this is only in Q1. This does not mean the rest. So this does not mean the entire year. So we could, things could still turn up. And again, we'll take a look at the overall 5 years right now, actually. So let's come, guys, into the discounted free cash flow, which is not this. Let's come into the discounted free cash flow. We got the ticker for CVX, market cap of almost $319.4 billion and a PE of 9.22 with a current share price of $168.58. And just like ExxonMobil, guys, this company is up 4.2% on the 1 year, and year to date it is up. It's actually down 3.11%. That's interesting. On the 5 year, let's take a look at this on 5 year. The 5 year is up 34.75%. And again, remember, guys, I said that my friend Rich, if you're still in the chat, make sure you comment. If you're still in the chat, Rich, he was telling me to buy this company at around like right here, $55, $60, right? Like right around here. I bought it at around like, you can see like it went to like 110 and then it got a pullback at around like right here, like August, July 2021, September, and I bought it at around like the $101, and ever since then, boom, massive jump. So that's essentially why I'm up this much when it comes to Chevron. But nonetheless, though, it's still doing very good overall on the 1 year. 52-week range, it is $132.54 to $189.68. Very interesting. We're not at 50. Well, yeah, we're not at 52-week highs or anywhere near it, but we are leaning more towards that. Now, they do pay out a dividend, which there's a reason why I like this company. They do pay out a dividend of a whopping $6.04, which, guys, it is a whopping yield of 3.62%. That's massive. For anybody who doesn't know, that's absolutely crazy. You would kill for anything above 2.5%. This is 3.62, and the share appreciation is absolutely massive. So it does have a lot of potential here. Payout ratio of 3.16%, a 5-year CAGR, a lot higher than that of Exxon's, of 5.76%, with a whopping 35 consecutive years of dividend payment, and increasing as well, meaning that this is a dividend aristocrat. Anybody knows that a company above $25, 25 years of consecutive dividend payment, it is a dividend aristocrat. Ex-dividend date passed as of February 15th. Payout date was on March 10th, and they pay their dividends quarterly. Now, based off the current shares outstanding, they pay out $11.6 billion in dividends every single year. And after this is paid, with regards to their 5-year average free cash flow, they still have left $6.52 billion. Now, Mike, what do you think it is going to be for the last year's free cash flow?
Probably massive. Probably double digits.
$26.1 billion. It's an increase of $20 billion from the average to the 1 year. That's insane. And this is the reason why I like Chevron a little bit better. The fact that their 5-year average free cash flow is looking a little bit better in regards to the payout ratio. Huh?
It's the inverse. It's like almost the inverse of Exxon, where
it's not inverse. It's not. No. Because Exxon's 5-year average was around like 65%.
Okay, I thought they were.
And yeah, and then for their last year's free cash flow, it was like 25 or something. So they're pretty in line. It's just I would prefer it if the 5-year average is under 60. So I mean they're both above 60, but this one's slightly under it. So, and on top of that, they're buying a lot more shares back. So this will go down essentially. Now let's come over into the actual fundamentals. It's looking very similar. By the way, I did change the numbers. All right, Mike, I did change the numbers. We got 5 years ago of $14.8 billion to 1 year ago of $35.46 billion. Increase of 139% for the net income. What would you give this as a grade, good sir?
I'm going to do 65, similar to Exxon's.
You said 85 for Exxon, my dude.
Did I say 85?
You did say 85.
I thought I swore I saw...
Yo, can the chat, like, prove, like, tell me yes or no? I'm pretty certain he said 85 for Exxon. I'm fairly certain you said 85. But whatever. What number? Forget about Exxon. We're doing now Chevron. What would you give Chevron?
65.
65. All right. 65%. All right. Looking now at the free cash flow. We got $16.83 billion to 1 year ago of $37.6 billion. Increase of 124% with an average of $18.1 billion. Grade.
70.
All right, 70. Is there a reason why?
Just because you had similar to Exxon the 5-year and the 4-year.
Yeah, it's very similar. Again, that's not really surprising. They follow the oil, guys. They follow the exact. They will follow. Yeah, if you pull up any kind of oil company, up to like major oil company like Exxon, Chevron, you're going to see something very similar. And looking now at the revenue, we got 5 years ago of $158.9 billion to 1 year ago of 244.3 billion, increase of 53.74%.
I'm gonna say 75.
75?
I do because it's just you are going exponential, but it's like you're really returning a lot to investors. You're not just
Well,
going
forget about that. We're looking at the graph, though. Remember, we're looking at the graph.
Yeah.
This is their bottom line, the revenue. Just based off of the graph, you got consistent decrease from 5 to 3, and then consistent increase from 3 to 1.
Yeah. Still
So,
75.
Still 75. All right, great. Looking now at the assets minus the liabilities. It's looking similar to that of ExxonMobil, except it's slightly increasing, right? You can see 155, 145, 132, similar, right? It's going down. And then, 130, 140,
Around
and
the
then
COVID
160,
years.
and then 160, yeah. Average total assets, it is $246.4 billion. Average liabilities, it is $98.76 billion. Doing this difference, we get a whopping almost $150 billion in this difference. So what would you give this as a grade? It's slightly
95.
increasing. Was that?
95.
95, right? 95 it is. And looking now at the cash flow minus the liabilities, I'm going. I hope you choose the right number when it comes to this. All right.
60.
Hang on. Why did you tell me 60?
The reason is that because for Exxon we did 55, I believe, for this, or 50. The reason that I'm saying that is you have 2 years that are above the average. The 2 year and the 1 year are above the overall average, whereas Exxon only had the preceding year that was above the average, whereas the 2 year was very close to the average or slightly below.
Okay, can I tell you that you're wrong?
All right.
Look at the 4 year.
Ooh.
Yeah, it's also lower than the average. And even their 5 year is slightly above the average. So
Yeah, that's pretty damn good. 70 or 75.
and even remove
and 3 year because it's COVID. So it's
remove the 3 year ago value, you could pretty much see a nice steady increase when it comes to this back to zero.
I'm gonna say 85 just
85?
because of like your 3 year exclusion plus you're heading in the right direction.
All right. And shares outstanding. Now this one is interesting because you could see that we got 1.9 billion shares outstanding to 1.915 billion shares outstanding from 5 to today. That is an increase. However, look at this, 0.65%. It's not really that much. And from the previous year to the current year, it's looking at 1 year ago, it's looking at 2 years ago of 1.929 billion to 1.915 billion. It's a decrease of a little bit more than 0.75%. So you can see that the main issuing of shares happened right here. 5 to 4, it was a decrease, issued shares, and then they issued a little bit more shares from 3 to 2, and then they started buying back. What would you give this as a grade?
I'm debating between
It's tough. It's tough.
because it's again the status quo. So you want to give. I'm leaning towards a higher grade. You are diluting a little bit, but you're not like. It's almost like a sine curve, whereas it goes up and goes down the exact same amount.
And on top of that, let me bring this back up. Hang on a minute. Recently increases target annual share repurchases to $17.5 billion.
I'm going to say 90 just because
right.
I don't like it should be buying shares back more aggressively.
Which they are.
Like,
I mean, they just announced that they will.
They announced they will, and do is two different things. You taught me that.
That's fair.
So I don't, because you got the status quo, you have kind of like that thing, and it gets to 100 once they start showing they're going to be buying the shares back. That's how I would look at it.
Right. All right. And lastly, when it comes to the cash equivalents, they currently hold $17.7 billion with an average of $10.27 billion. So we got, guys, the overall grade. Net income 65%, free cash flow 70%, revenue 75%, assets minus liabilities 95%, cash flow minus liabilities 85%, shares outstanding of 90%, 77%. So pretty much near 80, a little bit better than that of ExxonMobil. So, I mean, I personally like this company. I really, really do. And I would have given it different grades, but then again, that's just me. So maybe in the future, we'll have two separate one of these. One for you, one for me, and then we'll see where we go from there. But 77%, all right, not bad. Now, here's the thing. Do we buy it at the current share price? Because with the meteoric rise that Chevron has had, I don't know what we're going to see right here. So let's see what in the world we got with the discounted free cash flow. And, well, guys, not inputting anything, with a required rate of return of 10%, we got $138, not adjusting for debt, and then adjusting for debt, $142.20. Okay. Very, very close. In fact, I believe we were at this level a few days ago, if not very, very close. I think we went to like 150 a few days ago, right?
Low of $149.91.
Right. So fairly close to just the level, not inputting any revenue growth assumptions. So let's make some of these assumptions. We got forward 7.4%. Anything on that?
So what were their
Let's see.
orders?
Let's see. So we got the revenue. Let's see what we can find over here. Total revenues and other income. It went down from 2022 to 2023, 54.4 billion to 51 billion essentially. So it went down a little bit.
And again, this is their 5-year. That's not necessarily
right.
like
This is
quarter.
in the next 5 years. So
So
again, they're expecting 7.4.
And the sector is like about 13.
Well,
so
the sector median, yes, the sector median is 13.2. Yep.
So let's do, if they're projecting 7, 5, 10, 15.
5, 10, fit. Wow. Okay. Increases of 5. All right. 5, 10, 15. All right.
Yep.
And for the predicted share buyback.
So because, they fluctuate around, let's say -1. So that gives you like the issuance around 0 and 1.
0 and 1. All right. And with this, guys, well, we get the target share prices, not adjusting for debt, of $162.83 to $231.74. Now, adjusting for debt, this comes up. So that tells you something. $167.08 to $236.07. With a margin of safety of 5, 10, 15, $142.02 to $224.27. I personally would have given a whole lot different numbers, but that's just me personally. Mainly when it comes to the median and high assumption. But again, I'm gonna do yours, and then after this, I'm gonna do mine, just so that way you could see the difference. But based off of this, guys, I mean, we're pretty much there, right? There really isn't that much difference when it comes to 162 to 168, or even 167 to 168, right? 199 we're below, 194 we're below that right now, and these two are just way below. So this is looking fairly good based off of your revenue growth assumptions. Now, me personally, you guys know this is not financial advice. Every investment is the present value of all future cash flow. All right. So you guys just saw his numbers. Now I'm going to show you my numbers. I'm going to keep the projected share buybacks the same. Now, for the low assumption, I'm actually going to keep the revenue the same as well. But instead of 10, I'm actually going to go with 7. And then instead of 15, I am going to go with 9%. And there we go. So now it is 162.83 cents to 190, which, what was the 52-week high? $189.68. Yeah, right there it is. There it is. So adjusting for debt, it is $194 at the peak, with 180 in the middle. And you can see that you still have a lot of opportunities here to buy it in accordance to my assumptions as well, even though mine are significantly lower than Mike's. So again, guys, it really just shows that it really just depends what you believe the company will do in the future. So have these calculators, make your own assumption, read the earnings report, read their 10Ks, and make your own assumptions. Because it's not financial advice. Every investment is the present value of all future cash flow. I really do appreciate everybody that was able to come in on the live stream today on both YouTube and Rumble. So anybody who's watching the VOD, I really do appreciate it as well. So again, guys, please do your own due diligence. This is not due diligence, all right? This is not due diligence. Please have the calculators and make your own assumptions to see where you may lie. Because if you think that this is lower, if you think that they're going to do, for example, 2, let's say 3, and 4, well, now they're a lot lower. Now they're a lot lower. So it really just depends as to what you believe this company will grow in the future. So let's see what kind of dividend you will get with this $6.04. Putting in $5,725, you get $205, guys. That's incredible. That's incredible. And well, if I were to put this thing at the 101, which is my average share price, and I promise I'll change it back, you would get $342.38. That's crazy. Again, obviously I bought this thing, when the dividend wasn't $6.04, but you guys get the point though. It's looking fairly good when it comes to dividend perspective, and depending on what you put for the assumptions, also the price might be a little bit acceptable as well. So with that said, Mike, tell me, what do you got for Exxon?
All right. Not Exxon.
I always get the term wrong. Chevron. I am so sorry. Man,
You're going to get mixed up left and right.
Can't win today.
All right. So it's going to be a little ironic of that 230 price. And I say ironic. So first off, we're going to start on the daily. We're going to start at a small time frame and work our way up. You have a big, massive support on the daily at $151. So if some of those lower assumptions came in like we just showed you, that's where you'd be targeting that 151, or even I would basically say at the high assumption, 153.92. Do I believe Chevron is coming down there after the most recent move? I would argue probably not. You did have some price hitting in this consolidation zone here, and you went lower, tried to fill this price area here where you basically had a gap from the whole OPEC oil crunch, and now you're heading up higher. Earnings had a positive reaction. You gap down, everyone bought it basically back up, saying this is value. So once you get above the swing point here of the 172, it's pretty much clear skies ahead all the way up into the $185 region for Chevron. Remember,
that sounds familiar.
It was 187. So basically, looking at that, you got a nice push. You have the possibility of a nice push up and possibly an inverted head and shoulders. Left shoulder, head, right shoulder forming here. So we shouldn't stay around this region very long. We should be powering up and going much higher. I would expect at least at that $186 point. The MACD is starting to curl. It hasn't crossed yet, guys, and it's a little bit separated. So you got to be a little cautious on it, buying it here. However, seeing some other stuff that I'm going to show in a moment, I definitely think around this area is a very excellent buy. You may have some profit taking, you may have the market fluctuation, but again, you look at the longer term. That's what I always argue. Look at the longer term. Daily should be your lowest time frame. It shouldn't. You stop looking at charts on 4 hours. Stop looking at the 1 hour to determine long-term price action. Daily is your bare minimum or lowest that you should go. Bare minimum, you should go to the weekly. Speaking of the weekly, we have a doji candle on the weekly, basically signifying indecision after a huge range on the day. So again, it can go up and it can go down. Stocks can go also sideways, but a lot of people hear that and they say, well, you're just picking all three options. Well, I'm not. I'm aiming towards the upside. I'm just telling you what a doji signifies. So basically, your target for next week, do you break 164 or do you break 172? That's where basically you're going to determine the price action. You break those regions and hold and close the day, meaning you open and close the day above that region, then basically you're going to see price discovery much higher. So now where can we price discover to? Like we said, the $185 region is one of those targets. And then really as a stretch target up into the $198 region. But really, you have to see what you're going to do on the monthly. And this is where it gets really interesting. So you guys know I cover A to B patterns on the monthly. And Chevron, after having its meteoric rise, basically has formed a massive A to B pattern. If we take from the base to the swing high, back to the swing low here, you've now traded above the swing point just recently. So you're confirming this A to B pattern, which projects Chevron up to the $221 region. And the MACD is starting to maybe show weakness to the upside. When I say weakness, the selling momentum is slowing. You're basically making higher lows, higher highs, and basically the RSI hit that 50 mark and just said stop. And meaning it has the possibility, not a guarantee, that it could rip up higher. You get that swing up, and even you have a possible A to B pattern on the way up here, which projects you down to up, I should say, to the $199.13 range. So, you're going to probably stair step up, hit this target first, and have your runner target at 221. But overall, everything's pointing up. It's not pointing down. Again, the daily, just as simple as we can make it. Let's look at a longer time frame on the daily. Low, higher low, higher low, higher low. Bullish. It's like It's as simple as I can make it. You're making higher lows and higher highs. Now you made a higher or lower high just recently here with this big flush down, but you could be having a retracement pullback here and basically continue up higher. To me, having these type of pullbacks, especially because it trades so close to oil, is healthy for a stock. You just don't want a stock going straight up. That's how you get bubbles. You got the dot-com bubble, 2008, all this. Having stocks basically create price structure on the way up, gives you levels of support, and Chevron is no exception to that. So again, once you get above the swing point of the 172, have a weekly breakout, and you got to have a strong movement. You can't just break above, then fall on your face right back down. That's not what we want to see. You have to have a strong move up. With that strong move up, you have to have a strong move on the MACD. You don't want to create a MACD divergence here. And if you do, then I'd be looking more downside potential on Chevron, because you're going to stall out probably in that $176 region if that is going to happen. But long term, again, monthly view, guys, Chevron has a very bright future in my opinion, and it could significantly go up. If you have a downturn in the market, that Chevron is looked at as a safety stock and a recession stock in my opinion. So people are still going to need energy and all this, and you could see a massive flood into it, and it kind of just can trade outside of the market. So it has a lot of benefits, as I would say, especially with the price targets showing you a lot more upside potential. The technicals are showing you that, and just the monthly view just looks beautiful. I just see higher lows. It's as simple as that, and higher highs. Until you stop making that, until you break the low on the monthly close, so you would have to wait till end of May to find out if you're going to have a monthly close below 150, then basically you just keep going higher, buy every dip on Chevron, and that's the mentality you basically have to have for the company until it proves you otherwise. So that's all I got for Chevron, guys.
All right. And yeah, man, I think, listen, I absolutely love Chevron, and to this day, I kick myself because I should have listened to Rich. I really should have listened to Rich, but I didn't get it at the all-time lows, but I think I got a pretty good price point in my personal opinion. And actually, I'm selling puts like several months out on Chevron.
I was going to ask you, how's that thing going? How's
that
put going with Chevron?
So, okay. I'll go over this. Actually, I'll go over this very soon because I have to do my monthly video when it comes to the dividend / options premiums income for the month of April. So I will cover this in that video, so you guys will see that. But I have been, Chevron is only one of two companies that I actually have over 100 shares on. So I'm selling covered calls on it, and it's actually been very, very profitable. Now, I'm not making, $200, $300 selling those covered calls, but I'm making around like $20 to $40 depending on what premium I get and depending on whether or not the company is going up or down. And so far, it's been going very, very good overall. So I'm also selling cash secured puts on it as well at around the 101 price tag, the strike tag, because I'm like, I don't think it'll fall there, but if it does, I want to buy it there. I really, really do. So I'm selling covered calls on it, and I really don't want my shares to go away because, again, my goal, it is the dividend. So I don't want my shares to go away, so I'm managing that like a hawk. But at the same time, I'm also selling cash secured puts at really, really low strikes, way out of the expiration, several months out, just so that way I can get the premium. And on top of that, the likelihood of that happening isn't likely. But if it does happen, I don't mind it either because I want to buy more Chevron at $100. That sounds amazing. So, that's pretty much how that's going. And again, I will make a video specifically on that. And that pretty much does it, guys. When it comes to Chevron, I absolutely love it. It's my main staple when it comes to my portfolio. Great investment in my personal opinion. So, Mike, that pretty much does it for the companies that we wanted to cover. However, you wanted to cover one more. We're almost 2 hours in. Do you want to cover it now, or do you want to cover it on a separate video, just me and you? It really just depends up to you, my dude. And you muted yourself again, by the way.
Yep, I knew. Yeah. I was going to say we'll cover it on a separate video just because this week has been an absolute madness, and we are both exhausted. And
on top of that, this is gonna sound. I hate to bring this up, man. I really do, but and I'm not blaming you for anything. You could do it this weekend if you want. You got to do your stock recommended tickers for Friday.
Oh boy.
Yeah.
That's gonna be a fun video.
Yeah. So You know what you do, like the viewer recommended ones. Yeah.
Yep. And
Yeah.
Tony's definitely loading me up with stuff.
This is a job description. I actually hired him to do that. No, but yeah, like you can do it, for Saturday or for Sunday, whenever you have time. And again, we also have to do our market update video as well. So we'll probably do that tomorrow morning. So guys, we are exhausted. And okay, guys, next week, I'm fairly certain we have Apple next week.
We'll cover Apple, but I'm not going to say we're going to cover every single thing.
Yeah. Because again, remember, we do work on 9 to 5. If we didn't, we would not have an issue with doing this. But this literally took a lot of us, a lot out of us, and especially me, because all those videos that you guys have been seeing coming out sporadically throughout the day, I have been editing those videos. So after I'm done with the live stream, I then have to then take those videos and then edit them. So it's been a rough week, but we're more than happy to do it. It was a great experience. Thanks for everything, guys. No problem, KLL. Thank you for commenting and thank you for being so consistent. We really do appreciate you, Tony, now Anthony, right? Eli, but pretty much everybody that watches, man. Like, even if you're like a one-timer, or if like, oh, I hate these guys, they have no idea what they're talking. You know what? Thank you for watching. We really do appreciate it. We really do appreciate it. So hopefully one day, again, in the beginning of the video, hopefully, I said that the goal of the channel is to make this into a full-time job. Again, I want to do the Tim Pool kind of format where during the day I cover economic news and do maybe like a stock analysis on one or two companies per video. So that'll be 3 videos during the day. News, anything that comes up, stock analysis. That way you guys you guys get like 1 or 2 stock analysis throughout the day. Mike can do his technical analysis. Obviously, I'm talking about to the point that we're no longer having a 9 to 5 job. This is our job. And then at night, have like a live stream, just have like a live stream and, talk about the news, talk about, have guests. That'll be something, but, have guests, talk about, just all that stuff. So hopefully one day we can make that happen. But right now, the best way that you guys can help us reach that goal, like, subscribe, comment. Thank you so much for watching the live stream. Thank you so much for watching the VOD. Necrostalker, thank you. Thank you for the comment. I don't think I've seen you around too much, so you might be new. And if you are, then welcome aboard. If you're a lurker, then this is the first time I'm seeing you. So thank you for watching. We really do appreciate you guys.
Yep.
And with that said, we are 3 minutes away from 2 hours. So I think we're gonna end it here, guys. So peace out, and we'll see you all. Well, actually, in the next video, because we're gonna make another one we're gonna make several for this weekend. So it is what it is. So with that said, guys, and of course, Rumble. Thank you so much. I don't think there was anybody on Rumble, but you know what? If you guys watch the VOD on Rumble, we really appreciate you too. Yesterday, Rumble was awesome. So, guys, peace out, and we'll see you all next time.